Yeah.
When you start with the quick and dirty test, then you decide, is it worth the complicated analysis?
Yeah. There's a lot of lift on this building. There's a ton of buildings out there that are like this, Andrew, right? Like every time I see something on MLS, it's this. It's super low rents, overpriced, this and that.
It's going to actually allow us to do so much more.
I'm really excited. The studio's been in the works for quite some time.
In our brand new studio here in Burlington, Ontario.
The theme of this year, the theme of 2024, and I think the theme going into 2025 moving forward is going to be boring real estate.
Welcome back to REI Hot Seat. Andrew Hines here with Jacob Campanaro in our brand new studio here in Burlington, Ontario. Jake.
Yeah,
thanks for doing this.
It looks good, man.
Yeah.
I'm really excited. The studio's been in the works for quite some time. It's been sitting here. I've been eyeing it, and
like a 4-month project.
Really excited to get into it.
Well, we're talking about a off-market building today, and it is off-market, right?
It is.
Yeah, off-market 13 unit in Welland. So we're going to get into some of the high-level stuff here, and we're testing out a brand new live switching setup here. So we've got Shannon helping us out, and she's going to switch on the spreadsheet when we're ready. But anyways, so high level, let's just talk numbers about this. Actually, Shannon, if you could just pull up the, let's go to the buy tab on that spreadsheet. And you can see it's a $1.6 million proposed purchase price here. And the one thing notable, and you called this out right off the bat, Jake, is the as is, if you were to just go in and buy it, isn't really going to be that attractive for an investor. It's like 7.5. So on the bottom left there, you can see it's 7.5% interest rate.
Yeah.
25-year amortization. So it ends up being a pretty hefty mortgage payment. So then when you look over on the right side there, you see positive negative cash flow. Well, it's actually negative. And
so my first thought on this was, at first I saw it and I went, no, I don't want to do this property. And because I was thinking kind of old school, and I say old school, I think like a year ago, right? And I was like, oh man, it's all rented, right? What do we do? And then I was like, you're going to be negative cash flow coming into it. And so you're coming in negative on it. But the theme of this year, the theme of 2024, and I think the theme going into 2025 moving forward is going to be boring real estate. And that's kind of our team slogan right now. Every time somebody talks to us, we're talking about boring real estate. Well, what is boring real estate? And then when you showed me this one and we were kind of talking about it pre-show, I went, no, this is perfect.
Yeah.
Because I do want something that's boring.
Yeah. At 13 units, it's going to be purpose built. And I did see the photos. I guess we're not at liberty to disclose the address or the photos of it, but it is a purpose built building.
Yeah.
A little bit older. Like it looks like a 70s, 60s build.
Mm-hmm.
Decent shape. I'm not 100% sure if it needs anything from a life cycle standpoint.
Yeah.
Like
and so,
windows.
And really like what we're doing today, Andrew, is you and I both don't know this building extremely intimately. Most of the buildings we interview or we talk about on this show,
you know it pretty deeply.
At least one of us has intimate knowledge of the building.
Mm-hmm.
In this case, we don't. So this is going to be more of a high level review. But I do want to show this episode. I did want to do this episode too.
Yeah.
To basically get out there, like what is boring real estate? When we're talking about boring acquisitions or boring real estate, what does that look like? How do you analyze for that?
Yeah.
And what does an acquisition look like in that case? And we thought this was an okay example.
Right. Because there's a couple different ways you can go about this one. And Shannon, if you could pull up the spreadsheet again, and let's go over to the financials tab. So yeah, we're getting more sophisticated here. Eventually I'll be able to screencast this myself. But okay, so one of the main reasons that this is not cash flowing with the buy as is strategy is because there's money on the table with every single one of these units according to this analysis. So I believe this was somebody on your team that put this together.
Yes.
Yeah. So their estimate of market rent, but you can kind of go through, if you look at the monthly rents that are spec there, you can see that we're looking at, $814 on one of the 1-bed plus dens. We got a 2-bed at $887. Like there's a lot of meat left on the bone, so to speak there. Like it would make sense that market rent would be quite a bit higher than that. So I see a market spread anywhere from $200 to $600-$700 on these units. So cumulatively between all of those, I know the number wasn't done here. I'm just gonna sum it up because I want to see it. I know you can't see this on the main screen here, but $6,800 of potential additional monthly income according to the spreadsheet.
And what's that applied at let's call it a 5% cap rate?
So
annually.
if you take, let's see.
I love doing these calculations because people are always like, oh my gosh, really?
0.05. That's worth an additional $136,000.
But you did it monthly.
Oh, a month. Yeah. So times 12.
Do that. Yeah.
So in value on the building, that's worth an additional 1.6 million.
Yeah.
According to a 5% cap rate.
Sure. And
yeah,
we'll see where the cap rates go in the near future. But right now we're going to assume they're just hanging in there at around 5%.
And that's what you're seeing. Still stuff is trading.
Yeah. That's really where we're landing right now.
Okay. We're done with that slide, Shannon. Don't mind our hiccups, guys. Appreciate you sticking with us. We're going to really hone in our system with these episodes. And it's going to actually allow us to do so much more with being able to share screens and stuff.
No, this is amazing. And I'm just, Andrew keeps looking over and I look over.
Jake gets all distracted. So please,
don't worry. Because I'm watching Shannon do the mix live and it's we basically brought her in and did a crash course in 2 seconds.
Yeah.
So
you're doing a great job, Shannon.
Yeah. Good job. Thank you.
Appreciate it.
And sorry. So where I was going with this was, there's a lot of lift on this building. There's a ton of buildings out there that are like this, Andrew, right? Like every time I see something on MLS, it's super low rents, overpriced, this and that. Is this one overpriced? I don't know it well enough to decide that.
It's not that much over 100 a unit though,
no,
right?
It's not.
If you're at 1.6 for a 13 units.
And that's what I'm saying.
And it's a mix of ones, twos, and one plus 10.
So I think this is priced appropriately. Yeah. Honestly, I do. The big question is, well, how do I get into this property, not lose my shirt? You know, how do I actively turn over tenants? How do I do this? You know, paralegals, this and that. You don't.
Yeah.
And I think that's the concept of boring real estate is the game plan for this is going to be a CMHC acquisition.
Okay.
And shortly we'll flip to a page showing you that analysis.
Yeah. We should do that while you're talking. So go to straight to CMHC tab there, Shannon. You got that up? Okay, perfect. So on the straight to CMHC tab, I guess the key thing you want to note is on the P&L on the right side there, it actually has a positive cash flow. Now, albeit it's not huge, it's annually $4,300.
Right.
Yeah.
And that I think boils down to a pricing thing and a, interest rate thing. Like I just before I got into this episode, I just checked my emails and I had a CMHC mortgage come in for myself on one of my buildings, and it came in at our most competitive rate was I think 4.45.
Okay. So this one's factoring a 4.5% rate. The key thing here is the seller would have to be willing to wait, which I think a lot of sellers are probably more open to that, willing to wait for the approval.
I think you almost have to right now, honestly. And that's the whole concept of boring real estate. You get into it. We're going to do a 5-year play on this building, right? You're coming in, you're getting positive cash flow from day one with a CMHC acquisition. You have to.
Yeah.
And
then
you're
slowly
going to hold
units.
this for 5 years. You're going to slowly turn units. If somebody misses a payment, serve a notice. If someone's moving out, great. They're moving out naturally. Slowly renovate. Do everything with purpose, but it doesn't have to be done in year one. Right. And this is not the flip the building, get rich quick scheme. But listen, it worked for a few years. I don't think that's going to work right now. I don't think it will work in the near future. Like the key to this market is really about being slow and the slow and steady wins the race. I think that's a great analogy for
there's a lot of really successful investors that have preached boring, and I think that actually is I was just having this thought earlier today, so it's funny you say that. I didn't put it in those words, but I just thought Ontario is going to be that place where people who just want Ontario are going to throw down, some of them bigger down payments, and they're just going to trust that it's Ontario. There's demand for the real estate. It's going to be a long play. And that's some people, but I don't think you need to put bigger down payments. No, there's still a way to do it small. I truly believe that through CMHC acquisitions, right, we're going to go in, we're going to do a smaller 25% down. Some people will want to, though.
15% down, right? What's the most you can get with CMHC traditional? 85%.
Right. Yeah.
So that's a healthy mortgage. You put a small down payment down, you cash flow a little bit. If you want to cash flow more, put more down.
Yeah, exactly.
And just carry that thing through. And that is what we're preaching to our clients. That's why I thought this deal was interesting, because it is the essence of boring real estate. Yeah. And it's a good building though. It's solid. It's concrete and brick. It's built well. It's flat roof. Yeah. And so it's going to be around for a while. Right.
And there's one more tab I want to show here, Shannon, if we could. Let's show the stabilized refi tab. Okay, we're good. All right. So on stabilized refi, This is the idea that what if you could take all the meat off the bone with the under rented units and get that spread between current rent and market rent. And if we could do that across the board, that's that 5-year play you're talking about.
Yeah.
You're hoping that somehow in 5 years, if you can average 25% a year turnover, which I mean might be tough, but I know a lot of people who bank on that, and I've seen.
Well, Andrew, I know a lot of people that banked on 100% turnover in 1 year.
Yeah, that's with aggressive active turnovers,
right?
Versus natural turnovers. 25% I think is a more reasonable estimation. I think it might be lower than that in coming years because people know how much market rent has gone up. So even if it's 20% or 15%, but let's just say hypothetically you could do it in 5 years. Now you're getting your monthly cash flows to $2,000. Yeah, that's not huge, but it should be a very stable and bankable number at that point. I would assume that rents have probably even gone up from more at that point. So there might even be more meat on the bone.
Yeah. And to properly review and analyze this, I would say we got to build a different spread chart, a different spreadsheet, which I'm working on right now.
Yeah, we're doing a spreadsheet that's not native to either Jake or I, but I'm getting used to it.
Yeah. And I want it to be the boring real estate spread chart.
Okay.
And it's basically going to show you that 5-year spread, right? Because naturally you're going to have tax increases every year. You're going to have natural inflation on the expense accounts, right? So you need to, let's call that 2.5%. So we got to add 2.5% per year. Taxes maybe a little bit more, especially because we're going through a
right. So you're going to
reassessment.
do natural increases on those over the years.
Yep.
And you can get as sophisticated as you want with this stuff. I've always leaned away from that. And I think you guys do a great job of taking a template and just subbing it in. My cash flow sheet is like a 1-pager, super simple. I like to be able to analyze stuff quick and dirty.
And there's
then
room for both.
When you start with the quick and dirty test, then you decide, is it worth the complicated analysis?
Yeah.
That's why I start with quick and dirty. I wouldn't go right to the spreadsheet we're using on this show. I would start with mine or even like a blank spreadsheet and type in some numbers.
Yeah. And honestly, mirroring what you said, I would show a acquisition spreadsheet and an incomplete spreadsheet.
Yeah.
And that's been traditionally what we've done.
Yeah.
Right. And say, here's your, but here's your complete.
Yeah.
The part that I don't love about that is realistically, are you getting 100% of turnover in 5 years? Maybe, maybe not. It's more realistic than 1 year or 2 years.
It would be better to do some sensitivity. Like if you really want, if you're that close, question your motives and why you want the deal in the first place. But like if you're banking on that, that's not the deal for you.
I love that.
Yeah. But I mean, perform some sensitivity on it.
Yeah. Like
what if it takes 7 years? Boy, it'd be kind of cool to have a spreadsheet that could actually factor that in, and we could build that. That's just a matter of time.
Yeah. No, and I just think that's moving forward. We're going to see a lot more analysis done that way. Yeah. Right. And the traditional BRRRR and like spreadsheets are just they're not.
They're a little too simple for that.
I look at them and they just kind of like gross me out these days. Honestly, I'm just like like really you want to like that's the approach we're going to try is getting this done in a year.
Yeah.
I'd recommend against it unless it's vacant. And that's a completely different thing. Right. And we have been seeing there are people out there that are just buying buildings, getting them vacant, selling them.
Yeah.
Right. And that's a whole nother thing. So
the sentiment against renovations right now, it just makes it a little bit more risky to make that I'm going to do it all in a year type strategy. I would not go into something, to me, that's way beyond my risk tolerance.
Yeah.
I want something where I can go the natural turnover route and it would work.
Yeah.
So that would be more of my thinking if I was a buyer in Ontario for that kind of product right now.
Right. And even if it means like, for example, this building that we're getting CMHC on right now, we went in very aggressive. Like we went private, like right off the bat.
When you say which is this like one of your clients' buildings?
No, it's the Ghent Street building.
You're buying it?
On Ghent?
You're buying a building on Ghent?
We did that, like last year. Or not last year, earlier this year.
I didn't know.
Oh, okay. We'll review it. We'll do a review. I'm waiting for the CMHC to come through so I can show you like the whole life cycle of what we did.
Yeah.
Right.
Very cool.
We did acquire a bit more aggressively. But we knew that there was a CMHC play on this. So now we're getting it taken out with CMHC. And this is going to be a whole nother episode because I do want to do this one.
Okay.
But just saying, again, you don't always have to go CMHC acquisition.
Yeah.
There are ways to go CMHC after acquisition.
Like with the MLI Select still?
Not even, like just traditional CMHC or MLI Select, right? And so there are these different ways we can talk about this on a different show again. But have that 5-year plan. And hey, if you do it in 1 year, 2 years, amazing, even more money in your pocket.
Yeah.
Right. But plan for the 5 years.
Yeah. Plan for the worst and hope for the best. That's a better approach. And too many people, I think, that are new go in and they just think that they can smash the best case scenario. Like they're stacking, well, if we can do this and if we can do that, you're stacking your ifs.
Yeah.
Don't stack your ifs too tall.
Yeah.
Make sure you're okay with the worst case that you think it could be, or the reasonable worst case. And then anything from there is gravy.
Yeah. And I think, a lot of people come to us and go, well, Jake, how am I supposed to borrow money and use OPM if I'm doing 5 years? Right. And like, first off, OPM's tough right now for sure. I don't love using that acronym, but
like if you're paying, 10, 12%, you're getting into a territory where it's going to hurt on a longer term play like this. I think for me, I'd be looking more for a wealthy business partner that doesn't want anything to do with it.
Equity.
That wants to put some money in for equity. Yeah.
And that's the approach, right? And I think there's an angle here in this market to say, hey, look, I'm buying real estate that's going to take me 5 years to grow my wealth, right? And this is the pitch to the investors these days, to say it's boring real estate. I'm sorry, right? You're going to be in with me for a while, but guess what? I've run my tolerances, right? I'm not banking on a 1-year turnover. We're going to be in this for a while together. Let's build a relationship, just like you're saying, right?
Yeah.
And I think there's a stronger angle to bring in JV partners or investors that way right now than saying, hey, we're going to return your money to you at 20% a year quickly, right?
Cool.
That's just what I want to preach. And we're going to be talking, this is going to be a common theme throughout the year. We'll be speaking more about this.
Yeah. So let's tell the people what they can expect more of, because you've been making some changes on your end. There's quite a few more people on your team that are very focused on the commercial multifamily space. And we're going to have a lot more deals to review that are sort of internal to the team.
Well, yeah. So guys, same as always, there's a link below. If you go to the link, you can sign up. You'll come through our system. Right away, someone from my team is going to reach out to you. More than likely, it's either going to be Shannon, potentially Megan, and then you're going to go through our 3-step system. So we're trying to refine this approach. It's what we've been doing for years, but we're trying to put some names to it and have it a little bit more refined. But we are going to put you through the 3-step system. The first step is going to be a phone call from us, very similar to what we've been doing before. Hey, how you doing? What are you looking for? Why did you inquire? What's your favorite episode? It's fun. It's a great conversation. The next step is going to be, I don't want to call it educational because it's not necessarily always educational, but we're going to run you through the materials that Andrew and I look at, right? How does this work? Because we're going to provide you the same spreadsheets and the same analysis that we do on this show. And we want to show you, what does a good building look like? What does a bad building look like? And why, if you need that, right? Some of our investors that come through the show are more seasoned. They don't need that step. But we're still going to have that kind of educational step to say, hey, this is how we work. And then by the third step, we want to be, in a position where we're seriously talking about, hey, what is the right acquisition for you? If you're ready to acquire. If not, then hey, why don't we come out to our golf events or come out to the meetups and we'll talk further. And then in 6 to 12 months, maybe you're ready to buy at that time. We want to keep you within the network and keep having conversation because that's what makes things happen.
Yeah.
But yeah, it's so we'll go into more of the 3-step process as we go. But for now, what you guys need to know is just go to the link below. It's the same as always.
Sounds like you're talking about building a relationship, which I think that makes sense. Not everybody, it's going to be a tomorrow type of thing. It's going to be a grander plan of how this fits into what you're doing with your investment strategy in your life.
And that's what we've always tried to do, right? We don't pressure sale. We don't ask any of our clients. We're really easygoing with that stuff. It's more about, hey, let's just find the right fit.
Yeah,
maybe that takes 6 months. I don't know. But yeah, we want to build that relationship with you. So why am I saying all this is because even if you're not ready to buy right now, or you don't have something to refi right now, I still want you to come through the system. I still want you to log in below. Let's have that conversation and let's see, hey, is there a fit? Or maybe we can set that timeline up for you.
Cool.
Yeah.
All right. Okay, well, thanks for making it this far, guys, and show the channel some love if you wouldn't mind. Best way to kind of say thank you if you're enjoying the content, and we'd love it if you'd share it with somebody you think it could help. But until next week,
thank you very much.
See you then.